Gold has been trusted for centuries, but here's the catch. It doesn't produce income or grow in value by itself. Warren Buffett once said, "It just sits there staring at you." Is gold really the safe bet people think it is? Let's dig deeper. One of gold's biggest flaws is that it doesn't do anything. Unlike stocks, which represent ownership in companies that generate profits, gold is just a shiny metal sitting idle. Stocks give you a share of a business, a dynamic, growing entity that evolves, adapts, and creates value. Businesses produce goods or services, reinvest in themselves, pay dividends, and grow your wealth. Gold, on the other hand, remains static. It doesn't generate cash flow or dividends, and it doesn't grow over time. It's a purely speculative asset, relying on the hope that someone else will pay more for it in the future. Warren Buffett, one of the most successful investors in history, highlights this problem. If you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. This captures the essence of why gold doesn't compare to productive investments. Mark Cuban, another billionaire, once called gold a religion, explaining, "It has no real value other than what you can convince someone else to pay for it." In short, productive assets like stocks or real estate work for you. Gold, it just sits there, waiting for the next person to believe in its shine. Imagine you had $9.6 trillion to invest. What would you choose? A solid cube of gold, 68 feet on each side, or something far more productive? Warren Buffett once used this comparison to illustrate the opportunity cost of investing in gold. With that same $9.6 trillion, you could buy every acre of farmland in the United States, 400 million acres, along with 16 ExxonMobils, one of the most profitable companies in the world, and still have $1 trillion left in cash. Over the next century, the farmland would produce billions of tons of crops, and ExxonMobil would generate trillions in dividends, all while maintaining their intrinsic value. And the gold? It would still just be a 68-foot cube, unchanged and unproductive. As Buffett said, gold doesn't produce anything, it just sits there. This comparison highlights a critical truth. Choosing gold means giving up the opportunity to invest in assets that grow, generate income, and build real wealth over time. Gold's appeal may be rooted in its shine, but its inability to produce value makes it a costly and stagnant choice when compared to productive investments like farmland or businesses. One of the biggest reasons gold falls short as an investment is its inability to generate income. When you invest in stocks or bonds, you earn dividends or interest payments, real cash flow that can be reinvested to grow your wealth over time. This compounding effect allows your money to work for you, steadily increasing your returns. Gold, on the other hand, doesn't pay dividends, doesn't grow, and offers no income. It's entirely dependent on the hope that someone else will pay more for it in the future. Warren Buffett has criticized gold for this very reason, saying, "Gold has no utility. It doesn't produce anything." He highlights that productive investments like stocks or businesses create value by reinvesting profits or paying dividends. Gold, it simply sits idle. Mark Cuban shares a similar perspective. Gold is a religion. Its value is based solely on what someone else is willing to pay for it. This speculative nature makes gold a risky choice, as it offers no financial benefits beyond market sentiment. If your goal is to build wealth, prioritize assets that generate cash flow and grow over time. Gold may glitter, but it won't help you achieve long-term financial security. Investing in physical gold might seem straightforward, but the hidden costs can quickly add up. When you purchase gold, you're likely to pay a premium due to dealer markups, which immediately puts you at a disadvantage. But the expenses don't stop there. Gold needs to be stored securely, whether in a bank vault or a home safe, both of which come with ongoing costs. Add insurance to protect your investment, and you're already paying more just to hold on to it. When it comes time to sell, you'll often face additional fees, such as transaction costs or buyback penalties from dealers. These hidden costs can eat into your potential returns, making gold even less attractive as an investment. As Warren Buffett famously said, "Gold gets dug out of the ground, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility." These ongoing costs highlight a critical point. Gold not only fails to generate income, but also requires you to spend money to keep it secure. If you're looking to build wealth, investing in assets that grow and work for you is a far more cost-effective choice. Gold may glitter, but its hidden expenses can dull your financial future. Gold is often sold as a safe haven, but the reality is far from stable. Its value is driven by fear, speculation, and market sentiment rather than tangible fundamentals. For instance, during the 2008 financial crisis, gold prices skyrocketed as investors panicked, but in the years that followed, its value fluctuated wildly, leaving many with unpredictable returns. Unlike productive assets like stocks or real estate, which grow in value through innovation, earnings, or rent, gold's worth depends entirely on whether people believe it's valuable. That's not a sound foundation for building wealth. It's a gamble on human behavior. Warren Buffett has openly criticized this reliance on speculation, saying, "An investment in fear, thriving only when people grow more afraid. If fear fades, so does its value." This speculative nature makes gold a risky bet. Instead of gambling on fear, focus on assets that generate steady, predictable growth. Gold may glitter during uncertain times, but its volatility and lack of productive value make it a poor choice for those seeking long-term financial security. Gold's practical use is surprisingly limited. While it's widely used in jewelry and has some industrial applications, these account for only a small portion of its overall value. The majority of gold's worth comes from its perceived status as a store of value, rather than its actual usefulness. Compare this to other commodities like oil, copper, or iron. Oil powers industries. Copper is essential for electronics and infrastructure, and iron is the backbone of construction. These materials have tangible, functional uses that tie their value directly to economic growth and demand. Gold, however, doesn't play such a critical role in the modern economy. In essence, gold's value is propped up more by tradition and perception than by function, making it less tied to economic productivity and growth compared to other assets or commodities. Before we dive into the next section, take a quick second to hit that like button. It helps us reach more people and keeps us motivated to bring you top-notch content. Let's get back to it. If gold isn't the answer, where should you invest? The solution lies in productive assets like stocks, bonds, and real estate. Stocks represent ownership in companies that create products, innovate, and generate profits. These businesses reinvest in themselves, pay dividends, and grow over time, giving you the chance to benefit from their success. Bonds, on the other hand, provide steady income through interest payments, offering a more stable, predictable return. Real estate is another excellent choice, as it not only appreciates in value, but also generates rental income, making it a dual-purpose investment. These assets don't just sit there, they work for you, creating wealth while you sleep. Warren Buffett emphasized this when he said, "The best investment you can make is in productive assets, businesses, real estate, or anything that generates income and grows over time." Mark Cuban adds to this perspective, "The best investments are the ones that create value and produce results, not the ones you hope someone else will pay more for." Unlike gold, which relies on speculation and sentiment, These alternatives provide tangible, measurable returns. When it comes to investing, the world's most successful investors often steer clear of gold, and for good reason. Warren Buffett has expressed skepticism about its value, stating, "It doesn't do anything but sit there and look at you." This underscores his belief that gold lacks the productive potential of other investments. Charlie Munger, Buffett's longtime business partner, shares a similar perspective. "I don't have the slightest interest in gold. I like things that produce." These insights reflect a fundamental truth. Gold doesn't contribute to economic growth, innovation, or productivity. Unlike businesses that create products, provide services, and generate profits, gold remains a static, idle asset that produces no tangible output. Its value depends entirely on speculation and sentiment, not on its ability to produce or grow. As history shows, idle assets rarely lead to long-term wealth. Billionaires like Buffett and Munger emphasize the importance of putting money into investments that generate returns over time, assets that expand and create lasting value. Productive investments, such as businesses or stocks, offer the potential for compounding growth and financial security, making them far superior to gold. While gold may glitter without income, innovation, or growth, it falls short for anyone focused on building enduring financial success and creating generational wealth. When it comes to historical returns, the numbers paint a clear picture. Over the past 40 years, the S&P 500 has delivered an impressive average annual return of about 11.6%. In stark contrast, gold's annual return during the same period has been a mere 3.1%. While this difference might not seem overwhelming at first glance, it compounds into a staggering gap over time. Consider this. If you had invested $10,000 in the S&P 500 4 decades ago, your investment would have grown to over $1.5 million today, thanks to the power of compounding and the productive nature of businesses. In comparison, that same $10,000 invested in gold would be worth only about $33,000. That's the cost of choosing an unproductive asset over one that generates real growth. Warren Buffett underscores this point, saying, "A century from now, the 170,000 tons of gold will be unchanged in size and still incapable of producing anything. But productive assets will deliver value every year and continue to grow." Mark Cuban echoes this sentiment. Real wealth is built by investing in assets that create value, not by betting on static commodities. The lesson is simple. Historical performance shows that productive assets like stocks have consistently outpaced gold, making them the smarter choice for long-term wealth creation. Gold may glitter, but it simply can't keep up. Gold has long been associated with safety, and it's no surprise that its value often rises during times of fear. When markets crash, inflation surges, or global uncertainty spreads, people flock to gold as a supposed safe haven. This fear-driven demand can push prices up temporarily, but it often leads to overvaluation and poor long-term returns. Charlie Munger, Warren Buffett's business partner, critiques this mindset bluntly. Buying gold because you think the world is going to hell is not a very rational strategy. The logic behind this fear-based approach is fundamentally flawed. While gold may hold its appeal in moments of panic, it doesn't generate income, grow in value, or contribute to wealth creation over time. Warren Buffett adds, "Gold is a way of going long on fear, but it doesn't produce anything. You're betting that more people will be afraid in the future." This reliance on fear and sentiment makes gold speculative at best. History has shown that fear fades, markets recover, and those who invest in productive assets, stocks, real estate, and bonds reap the rewards. Gold might shine when panic strikes, but it's no substitute for investments that create real value and grow over time. If building lasting wealth is your goal, don't let fear guide your financial decisions, as it often leads to unproductive financial behaviors. Gold may have a glittering appeal, but when you look closer, its flaws become impossible to ignore. It doesn't generate income, doesn't grow, and comes with high costs for storage and security. Worse, it relies on speculation and fear, rather than productivity and value creation. As Warren Buffett puts it, it's far better to have a goose that lays eggs than a goose that just sits there and eats storage fees. Instead of putting your money into an unproductive asset like gold, consider investments that truly work for you: stocks, real estate, or bonds. These assets generate income, appreciate over time, and contribute to long-term financial security. If you're serious about building a strong financial future, don't be fooled by the glitter of gold. Focus on investments that create value and grow your wealth, even in times of uncertainty. If you found this video helpful, hit the like button, subscribe to the channel, and let us know your thoughts in the comments below. Also, check out our video on how to make millions during pandemic, advanced investment strategies to build wealth, for more tips to secure your financial future. Stay tuned for more content that keeps you informed and inspired.